Picture this. It's 1998. The internet is the hottest thing on the planet. Every investor you know is throwing money at anything with a .com at the end of the name. And for a while, it works. Your portfolio climbs. People call you a genius. Then 2000 hits. The NASDAQ doesn't just dip, it craters. Down nearly 80%. Fortunes built over years, gone in months. Companies that were worth billions on paper became worth nothing almost overnight. I watched people I knew personally lose everything. And even though I saw it coming, my own portfolio still took a serious beating. Here's the wild part, though. The internet genuinely was the future. The technology was real. The problem wasn't the idea. The problem was the madness surrounding it. And right now, sitting here in 2025, I'm getting that same feeling again. The technology driving the frenzy this time isn't the internet. It's artificial intelligence. And people are treating it like a once-in-a-generation golden ticket. Maybe they're right. Or maybe we're watching the same movie with a different cast. There's a famous quote by investor John Templeton. The 4 most expensive words in investing are, "This time is different." So, is it actually different this time? Over. 7 million of you have started investing because of this channel. That means I owe you my honest, unfiltered take. So before you make any moves, let's break down the 3 hidden forces driving what could be the biggest bubble of our lifetime. And more importantly, what you should actually do about it. Force number 1, the Magnificent Seven and the AI arms race. Right now, 7 companies are essentially holding your financial future in their hands. You've probably heard them called the Magnificent Seven: Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and NVIDIA. Together, these 7 companies make up roughly 36% of the entire S&P 500. If you own an index fund, and most of you do, you're already deeply exposed to all of them. And every single one of them is locked in a full-blown arms race to dominate AI. Let's look at the numbers, because they're genuinely staggering. Tesla is putting $5 billion toward autonomous driving and Elon Musk's AI venture. Apple is spending $10.7 billion trying to finally make Siri useful. And honestly, it's probably going to take more than that. Meta is pouring roughly $60 billion into data centers and AI infrastructure. Google is throwing $75 billion at rebuilding how the internet itself works. Microsoft is committing $80 billion to fund OpenAI and build supercomputers. And Amazon is going all in with $100 billion through AWS to own the backbone that every other company runs on. Add it all up, you're looking at roughly $330 billion in a single year. To put that in perspective, that's more than the entire GDP of Finland or Portugal in 1 year on AI. Now, here's where it gets uncomfortable. A significant chunk of this spending is actually what's keeping the broader economy from sliding into recession, which raises a very important question. What happens if the spending stops? Global AI investment is expected to hit $500 billion by today. Desperate to win? Because the IMF estimates that roughly 60% of jobs in developed economies are exposed to AI disruption. Whoever controls this technology controls the future, not just financially, but geopolitically. The race isn't just between companies anymore. It's between the United States and China, and both sides are burning billions to make sure they come out on top. For investors like us, this creates two very different possible outcomes. If AI delivers on its promise, the next decade could look like the internet boom on steroids. But if the profits don't show up fast enough, the same stocks inflating your portfolio right now could be the ones dragging it underwater tomorrow. Number 2. The AI money machine. This is the part that genuinely worried me when I first understood it. Let me walk you through what's being called the AI money machine. Here's how the ecosystem works on the surface. Chip companies like NVIDIA, AMD, and Intel design and sell the processors that power AI. AI companies like OpenAI buy those chips. Data center operators like Oracle and CoreWeave also buy chips, then rent out computing power back to the AI companies. Clean enough so far, right? But here's where it starts getting messy. Microsoft pours enormous funding into OpenAI. OpenAI uses Microsoft's cloud infrastructure and pays them back for it. Microsoft takes that money and buys more NVIDIA chips. NVIDIA then reinvests back into the broader AI ecosystem. And because multiple companies are recording the same flow of money as revenue, valuations keep climbing because markets reward revenue growth. Let me give you an analogy. Imagine I go into the woods with a friend. I pay him $1,000 to dig a hole. He pays me $1,000 to fill it back in. We both technically still have $1,000, but we can both now claim we generated $1,000 in revenue. And if a market valued our hole-digging business at 40 times revenue, we'd each look like we're worth $40,000. Nobody's literally passing the exact same dollar around, but the underlying dynamic is real, and it's getting bigger. Enormous infrastructure deals, massive compute contracts, data centers responding by ordering more chips from NVIDIA, NVIDIA investing back into the ecosystem that keeps demand alive. Round and round it goes. The dangerous part? It can make demand look guaranteed, even when actual end-user profitability hasn't been proven yet. Think of it this way. NVIDIA sells the shovels. Data center companies provide the land. AI labs are digging the mine. And they're all helping each other excavate before anyone has confirmed how much gold is actually down there. OpenAI, for example, carries a valuation that suggests it's minting money, but it's still burning through enormous amounts of cash every single month. So will these AI companies ever generate profits large enough to justify their stock prices? It's possible. Here's why. Hundreds of millions of people use AI tools every week. That's an incredible amount of attention, and more importantly, an extraordinary amount of data about what humans actually want. The moment these platforms start running ads, or the moment they allow brands to plug directly into conversations and make product recommendations in real time, that could unlock a revenue model unlike anything we've seen. On top of that, AI companies are actively building tools designed to replace expensive human labor. Once businesses become dependent on AI the way they're dependent on email, those companies can raise prices and finally start collecting. So yes, AI is genuinely valuable, but much of that value still rests on a single assumption:
that the pace of progress keeps accelerating, which leads us to the third force, the data wall. AI has been improving at a breathtaking pace. A couple of years ago, AI-generated video looked like something out of a fever dream. Now it can actually fool people, at least for a few seconds. The entire stock market is betting that this rate of improvement continues, because if AI keeps getting smarter, companies keep spending, investors keep believing, and valuations keep climbing. But there's a problem quietly approaching on the horizon, something researchers call the data wall.
For years, AI systems have been consuming essentially every piece of quality public information available online. Books, articles, research, code, decades of recorded human thought, all fed into these systems at once. No wonder progress has felt so fast. It's been like sitting down to the largest buffet in human history. But what happens when the buffet runs out? At some point, there simply may not be enough new, high-quality, human-generated content left to train on. And when that happens, progress could slow dramatically. In a market priced for speed, slow is dangerous. Now, can this wall be broken through? Possibly. Because humans don't just learn from data. We learn from living. We make mistakes. We interact with the world. We adapt through experience. AI doesn't naturally have any of that. The next frontier may not be more data. It may be different data. Data generated through real-world interaction, robotics, simulation, and feedback loops that let AI systems actually test ideas rather than just predict the next word. If AI companies crack that, the ceiling gets dramatically higher. If they don't, we could see progress plateau, spending slow, and valuations reset very quickly. So, is this really comparable to the dot-com crash? Not entirely. And that distinction matters. The biggest difference is that AI is genuinely useful. It has real applications. There is a credible path to significant profit. That's a very different situation from 1999, when companies were getting billion-dollar valuations just because they had a website and a clever name. But does that mean it's not a bubble? Honestly, I still think it might be. The warning signs are all present. Stretched valuations, circular financial arrangements, geopolitical hysteria, technical scaling limits, and the single most dangerous ingredient of all, the collective belief that this time is different. The uncomfortable truth is that nobody can tell you exactly where we are in this cycle. We could be at the beginning of a decade of extraordinary innovation, or we could be closer to the edge than most people realize. What should you actually do? So what's the right move? Here's what I'd tell anyone investing right now. First, keep investing. If we're still in the early stages of this cycle, prices today could look like bargains in a few years. The smartest thing most people can do is set up an automatic monthly investment into a broad, low-cost index fund and leave it alone. I did exactly this during the dot-com era. My portfolio still got hurt when the bubble burst, but I don't regret it, because the market recovered as it historically always has. The real skill isn't predicting the crash. It's not panicking when it happens. But to do that successfully, you have to make sure you're not over-leveraged. The people who got wiped out in 2000 didn't just lose money in stocks. They lost money in stocks while simultaneously drowning in debt, margin calls, and bills. That combination is what destroyed them. Second, grow your income. Your earning power is the engine of your wealth. A promotion, a new skill, a side income stream, any of these supercharge your investment strategy, especially during a downturn, because when markets fall, every dollar you invest buys more. Downturns don't feel like opportunities, but for people with consistent income and no panic, that's exactly what they are. Third, diversify. Concentrating everything in one type of asset is how people get permanently set back. Spread across stocks, bonds, real estate, and depending on your risk tolerance, maybe a small allocation to precious metals or crypto. Also worth considering, dividend-paying companies. When prices are falling, cash flow from dividends can keep you grounded and in the game. And the last thing, if this bubble does burst, it will not be the end. It will feel catastrophic. The headlines will be terrifying. But if you understand what's actually happening underneath all the noise, you won't be the one running for the exit. You'll be the one quietly picking up what everyone else is throwing away. Whether AI turns out to be a bubble, a genuine boom, or some complicated mixture of both, the worst position you can be in is an unprepared one. So stay informed, stay diversified, keep investing, and don't let the noise make your decisions for you. If you found this useful, hit the like button, subscribe if you're not already, and turn on notifications, because this story is far from over. Thank you for my video watch. Subscribe my YouTube channel.